Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 156, and in this episode we're reviewing the performance of the global markets during the 16th week of 2025, and that is from Monday the 14th to Thursday the 17th of April. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Wednesday, in a speech to the Economic Club of Chicago, the Federal Reserve Chairman Jerome Powell expressed concern that the central bank could find itself in a dilemma as it seeks to balance between containing inflation and supporting economic growth. With uncertainty elevated over the potential impact of tariffs, the chairman said that while he expects higher inflation and lower growth, it was still unclear where the Fed would need to devote greater focus. Tariffs, which are essentially a tax on imports, have placed the Federal Reserve between a rock and a hard place, given its dual mandate of ensuring price stability and full employment. According to the CME's FedWatch tool, markets are projecting that the Fed will revert to cutting interest rates in the month of June and is expected to deliver at least 3 rate cuts of 25 basis points each before the end of this year. And as always, throwing a spanner into the works, on Thursday, President Trump once again called on the Federal Reserve to lower interest rates and even hinted at the termination of the Fed Chairman Jerome Powell. These comments by President Trump were posted the day after Powell's speech, in which he noted that the ongoing tariff war had put the central bank in a difficult position of balancing between taming inflation and boosting economic growth to achieve full employment. This was not the first time that Trump has criticized Powell's approach to monetary policy, as he insisted that this was the perfect time for the Fed chairman to cut interest rates. For your information, like most major central banks, the Federal Reserve is an independent institution that is not influenced by short-term political considerations, but instead relies on solid economic data to determine the direction of monetary policy. Over to China, where despite the ongoing tariff war with the United States, China's economy recorded a better than expected growth rate of 5.4% in the first quarter of 2025, beating market expectations for a growth of 5.1%. Following the implementation of a broad stimulus policy in 2024, the Chinese economy now appears to be on the recovery path. The Chinese leadership has set an ambitious growth target of around 5% in 2025, but this will be difficult to achieve due to the escalating trade war with the United States, as well as persistently weak domestic consumption. In the Eurozone, on Thursday, the European Central Bank announced yet another 25 basis point rate cut as the escalating tariff war continues to create widespread uncertainty and has raised concerns about the outlook for global economic growth. This rate cut, which was fully priced in by the markets, now takes the central bank's deposit facility rate down to 2.25%, which is way below its peak rate of 4%, which was hit in mid-2023. In its policy statement, the central bank's governing council said that the outlook for economic growth had deteriorated owing to the escalating trade tensions. Despite the uncertainty created by the ongoing tariff war, the European Central Bank decided to maintain its current policy stance and was the main reason for this latest reduction in interest rates. In the United Kingdom, according to data released by the Office for National Statistics on Wednesday, the annual rate of inflation in the United Kingdom fell to 2.6% in the month of March. This inflation reading came out slightly below the consensus forecast, as economists polled by Reuters had anticipated that the consumer price index would rise to 2.7% in the 12 months to March. Inflation in the UK has been on a downward trend, dropping from 3% in January to 2.8% in February, and is now at 2.6% in March. Core inflation, which excludes volatile food and energy prices, rose by 3.4% in March, and this again was down slightly from 3.5% in February. This latest inflation data will be closely analyzed by policymakers at the Bank of England, who are widely expected to cut interest rates at their next policy meeting that is scheduled for Thursday, the 8th of May. At its previous policy meeting in March, the Bank of England decided to keep its policy rate on hold at 4.5%, given the uncertainty over global trade and economic growth. In the land of the rising sun, the annual rate of inflation in Japan increased to 3.6% in the month of March, marking the third consecutive year where headline inflation has been above the Bank of Japan's target rate of 2%. Core inflation, which strips out the price of fresh foods, came in at 3.2%, which was in line with market expectations. Meanwhile, the so-called core inflation, which strips out both fresh food and energy prices and is closely monitored by the Bank of Japan, this rose to 2.9% in the month of March. This inflation data comes at a time when Japan is engaged in trade talks with the United States after being hit with a 25% tariff on auto imports and another 25% levy on steel and aluminium imports. On Wall Street this past week, following a choppy trading session on Thursday, the S&P 500 ticked up for the day but still finished the week on a lower note as concerns about tariffs continued to weigh down on investor sentiment. Stocks briefly took a leg up on Thursday afternoon after President Trump said that he was expecting trade deals to be concluded with both China and the European Union. This comment came a day after the Federal Reserve chairman spooked investors by saying that Trump's tariff policies could drive up inflation and further delay the reduction in monetary policy. After swinging between gains and losses earlier in the week, the broad market index advanced by 0.1% to close at 5,282, Meanwhile, both the Nasdaq and the Dow posted 3 consecutive days of losses, with the tech-heavy Nasdaq Composite inching down by 0.1% to end the week at 16,286, whilst the 30-stock Dow Jones Industrial Average shed 527 points or 1.3% to settle at 39,142. All the 3 major indices posted losses during the past week, with the Dow and the Nasdaq each losing more than 2%, whilst the S&P 500 slid by 1.5%. In the U.S. government bond market, the yield on the 10-year Treasury bond advanced on Thursday as investors weighed on the state of the U.S. economy after the Federal Reserve Chairman raised concerns about higher inflation and slower economic growth due to the tariff policies adopted by the Trump administration. President Trump's tariff policies have created uncertainty not only for the U.S. economy but also for the global economy, with the Fed chairman saying that he expects a rise in inflation and a decrease in economic growth for this year. Investors are also considering the remarks made by the Fed chairman when he said that given its dual mandate of price stability and full employment, the Federal Reserve finds itself in a sticky dilemma of trying to control inflation and support economic growth at the same time. The yield on the benchmark 10-year Treasury bond rose around 5 basis points to settle at 4.33%, whilst the yield on the policy-sensitive 2-year Treasury note ticked up by about 1 basis point to perch at 3.80%. For your information, bond yields and prices move in opposite directions, and 1 basis point is equal to 0.01%. In the oil market, the price of crude oil rose more than 3% on Thursday after the United States imposed new sanctions on Iranian oil exports. The new sanctions on Iran has raised concerns about global oil supplies and pushed up the price of crude oil. The International Energy Agency has cut its forecast for oil prices on the back of weaker global demand as the ongoing tit-for-tat tariff war throws global trade into disarray. Both benchmarks booked their first weekly rise in the past 3 weeks, gaining by about 5%. The price of the global benchmark, Brent crude, rose by 3.2% to close at $67.96 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, increased by 3.5% to settle at $64.68 per barrel. In the precious metals market, the price of gold eased off on Thursday after a sharp rise in the previous session as investors booked profits ahead of the long Easter holiday weekend, although escalating trade tensions between the United States and China kept bullion above $3,300 per ounce. The price of gold surged by 3.6% on Wednesday, driven higher by President Trump's order to open an inquiry into potential tariffs on the importation of critical minerals. The price of spot gold gained nearly 3% this past week and touched a new record high of $3,357 before correcting slightly to close the day at $3,326 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where during the past week, the Kenyan shilling depreciated marginally versus the US dollar, and according to data from the Central Bank of Kenya, The official exchange rate for the dollar was quoted at 129.79, and this was up from 129.67 that was recorded the previous week. Meanwhile, the sterling pound was priced at 171.43 and the euro was valued at 147.35. And on the regional front, one Kenya shilling was changing hands for 28.24 Ugandan shillings and 20.61 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.87. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any unforeseen circumstances, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $79 million for a grand total of $9.80 billion, which is equivalent to 4.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. For your information, please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, the liquidity situation in the interbank market during the past week was sufficient to meet demand and was also supported through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the economy. The average interbank rate, which is the rate that banks lend to each other on an overnight basis, this declined further from 10.12% the previous week down to 9.80%, in line with the recent reduction in the central bank rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 11.7 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 17th of April, and the central bank received bids totaling to 38.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance of about 160%. The central bank, however, ended up accepting only 36.3 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 3 basis points to average out at 8.46%, whilst the 182-day rate declined by 13 basis points to level off at 8.75%, and the 364-day rate shed about 16 basis points to settle at 10.07%. In the primary bond market, The Central Bank of Kenya has published a second prospectus for the month of April, in which it is looking to raise a total of 80 billion shillings for the stated purpose of budgetary support. The central bank is now inviting bids for the following 3 reopened treasury bonds whose terms and conditions are as follows. The first bond is a 15-year bond originally issued in 2022 with 12 years left to maturity and a coupon rate at 13.94%. The second bond is a 25-year bond initially issued in 2022 with 22.5 years left to maturity and a coupon rate at 14.18%. And the third bond is a 20-year bond initially issued in 2012 with 7.6 years left to maturity and a coupon rate at 12% flat. Please note that for the first 2 bonds, the central bank is looking to raise a total of 50 billion shillings, and these bonds are now open for sale until Wednesday, the 30th of April. Whilst for the third bond, the central bank is looking to raise a total of 30 billion shillings, and this bond is open for sale until Wednesday, the 7th of May. Up next is our topical issue, and this week we are looking at the reduction in interest rates in the Kenyan markets. Interest rates on treasury bills have settled at a 3-year low as the market continues to price in the latest reduction in the central bank rate. The interest rate on the benchmark 91-day treasury bill has fallen from its peak of 16.72% in April 2024 down to its current rate of 8.47%. At its last policy meeting that was held on the 8th of April, the Central Bank's Monetary Policy Committee decided to further reduce its benchmark lending rate, that is the central bank rate, by 75 basis points from 10.75% down to 10% flat, with a view to stimulating lending to the private sector and supporting economic activity. In line with the reduction in the central bank rate, the interbank rate has also fallen to around 9.8%, which is the lowest level since August 2023. For your information, the interbank rate is the rate that commercial banks use to borrow and lend to one another, usually on an overnight basis, in order to ensure they have sufficient liquidity for their day-to-day operations. In addition to reducing the central bank rate, the Monetary Policy Committee also narrowed the interest rate corridor for interbank lending to no more than 75 basis points, either above or below the central bank rate. What this means is that the interbank rate is now restricted to a maximum rate of 10.75% and a minimum rate of 9.25%. The easing of monetary policy by the central bank has complemented previous policy actions, such as the reduction of the cash reserve ratio by 1 percentage point down to 3.25%, which has made available additional liquidity for onward lending to the private sector. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please consider supporting this podcast by becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic Easter weekend. And remember, you do not see things the way they are, but rather you see things the way you are. Think about it. Thank you, and God bless.